Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the November edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the markets and the investment universe that you need to know right now. Bob, it's going to maybe be a challenge to find something to talk about this week. Not much going on in the world, but hopefully we can dig deep into our topical resource and come up with something, huh?
Yes, between the election this week and the Fed announcement coming out today, there's plenty for markets to digest and for us to talk about.
Yeah, so we wanted to wait. Usually we record this on like a Wednesday afternoon. We wanted to wait until Thursday morning just to see if yesterday's market activity at the open continued. Not that it matters necessarily long term, but I was curious. Sometimes you see these election day moves or early day moves that start in one direction and change course. But yesterday that wasn't the case. The market opened up strong. Well, stocks did, at least. U.S. Large cap, small caps had an amazing day. Bond yields went up, which hurts bond prices. So I know we're not going to talk day-to-day activity here, but what did you see yesterday in reaction to the Tuesday election?
Yeah, so just to digest the market's response yesterday, it was a strong day for U.S. stocks. The U.S. total market was up 2.5 to 3% approximately. Small caps had a great day. The Russell 2000 index was up close to 6%, I think around 5.8 or so. So that's a really strong one-day return for small cap stocks. Foreign markets, international developed and emerging markets, both were down about 1%, and bond yields were up. So like the Bloomberg U.S. Aggregate Bond Index was down about 0.7, 0.8%. So wrapping all that up, what's happening, and some of the pundits call it the Trump trade, and markets are digesting Trump's policies that he's spoken about, which the main ones that I think have been driving markets are lower taxes or an extension of the Tax Cuts and Job Act, which is stimulative. It's more money in people's pockets, more money in companies' pockets. So that's good for economic growth. Why small caps are doing better than large. Small caps tend to be more cyclical. So they're kind of, think of it as levered to the economic cycle. So if you're going into a recession, you don't want to be in small caps. If you're going into an economic boom, you want to be in small caps. So I think that's kind of the story that is led to the small cap performance yesterday. And then tariffs. Trump's talked a lot about tariffs, and that's I think foreign markets why they were down about 1%. It's more of a pro-U.S. story. And then the bond part. Why are bond yields going up in spite of all this? Part of I think the concern with the Trump plan is it's probably good short term, but long term it does lead to it's more debt and deficits. And that's not good for the bond market. And it's also inflationary, potentially. Inflationary from the tariffs, that can be inflationary. Inflationary from lower taxes, that's stimulative, more money in people's pockets, more money to spend. And then also his immigration policy, that can be inflationary as it impacts the jobs markets.
So that's kind of where I'm leaning on this, and I'm wondering if you're okay with my lean on this, just internally in my head. Like, I feel like yesterday didn't really say much. If bond yields are going up, stocks are going up. Stocks are going up because of the growth aspect of the potential outcome, and yields are going up because of, I wouldn't say the negative implications, but the inflationary implications of, that same election. It doesn't resonate with me. I feel like things have to shake out in the next little bit in one direction or the other. Either you have to see yield stabilize, or maybe the stock rally, shortens out a little bit. I don't know. I'm just talking, but those do seem to be kind of contradictory pushes.
Yeah, it's definitely fair, and it's going to be tricky. His advisors are going to have to walk a very fine line on inflation, because he had a similar playbook the first time he was elected. And then like the day before he was elected, the 10-year Treasury yield was, I think, 1.88%. There's no concern about inflation. So you take that economy back in November 2016 and you can throw some gasoline on it and it had room to warm up. Right now, we're coming out of a inflationary environment and we're still not done. We're still not at the Fed's 2% target. So it may not be the right time to say pour some gasoline on this economy. I mean, the irony is he could say he won because of the inflation during Biden's term, and people didn't like it. And now he's coming in, and his policies may very well lead to inflation again, which I think the average voter wouldn't appreciate. So yeah,
Taking those guys out of the equation, which I think a lot of people would rather we just talk money versus individuals. We've talked, you and I, in the past, not on this podcast, but in your office, that in terms of where we are in the economic cycle, that you thought we were late cycle.
yes,
And late cycle meaning, there are stages of an economic cycle, right? There's an expansion, then there's the peak, then there's contraction, then there's the trough, and then the party starts all over again. And we had a blip of a recession in 2020, I think, because of COVID. And you and I think, had the same view that that was basically not a complete market cycle, and that we've been in the same recovery that we've been in for a long time. And so I asked you, where do you think we are in the cycle now? You said, I think we're late cycle, and I panicked a little bit because late cycle means right to the end. You said, well, late cycle can be a very long period of time, but just in general, what you're saying, connecting back to the election thoughts, is it can be good. Late cycle can be long. The market makes some of its best money late in its market cycle, but maybe too much stimulative very late into an economic recovery or an expansion can sow the seeds of its own demise potentially down the road.
yeah, that's all right. And it's a delicate balance when you're late cycle. So really, I would say when he was first elected in 2016, valuations were lower. Just the setup was better. So this is going to be, regardless of who the individual is or who's elected for the next 4 years, with where prices are, with where, meaning like price to earnings ratios and equities, where valuations are in equities, where we are in the economic cycle, it's going to be more challenging to deliver strong results for the markets over the next 4 years.
For the U.S. market. So the setup for my next question is, just reminding listeners or new listeners who may not know, we are very globally diversified in our portfolios. We own the global stock market. We don't own just large caps. We own mid caps, small caps. We have a fair and healthy allocation to value stocks. And then we own fixed income, real assets, alternative assets where appropriate for our clients. So in an environment that you're going into where you're already very well diversified, in our opinion, is anything that we just talked about going to lead to any portfolio changes in your mind at Heritage, or is this more of a conversation for people who aren't already diversified?
Nothing major, but the one area I would highlight or circle is just to make sure you have the right amount of inflation protection. And we do have a decent amount, but that is the one area we're looking at because I think there is a heightened risk of inflation coming back, and it's still on the lower end, but we look at all the risks out there, and inflation is a major risk factor that you just want to be protected from. So that's the one area which you get protection from through real assets, through short-term bonds, equities in some cases. So we have it, but that's the one area that I would look at.
What about the international stock markets, Bob? I mean, you referenced the day yesterday. I think it could be case could be made that the dollar won't weaken in an environment like this. You talked about the tariffs already. I know I'm repeating myself there, but is there any thought or caution to just the international or developed or the emerging markets exposure, just given what we're seeing this week?
Yes and no. On the yes side, when you have policies that aren't favorable for international markets, the obvious position is yes, be cautious. Why I say no is they have lagged for a while, and there's a lot of negativity built into the price. And then one thing to keep in mind that I frequently remind people when you talk about investing is really for every buy, there's a sale, and for every sale, there's a buy. So if you say, well, I'm going to be negative on international markets, what are you going to be positive on? And typically the response to that would be US markets. And if you look at the valuation of US markets, it's pretty high compared to history. So to put all your eggs in the all your equities in the US basket, when we're at the one of the higher levels we've seen in history, I'd caution against that. So I think globally diversifying makes sense, and I'd stick with it.
I appreciate that recap, Bob. So the other thing is the Fed's meeting today, I think this afternoon, and the expectation is for rate cuts still. But can you walk us through that? Because I know the jobs market has sent some mixed signals, I guess,
Yep.
since the last cut, and people have changed their mind as to how aggressive of a rate cutting stance we're going to see. But I believe the market is still expecting 25 basis points today. So, what have you seen over the last couple months there?
Yeah, the previous meeting they cut by 50 basis points, and I believe right after that, there was a time about a month ago or so where it was expected that this meeting today that they were going to cut by 50, but they've always said we're going to review data as it comes in, and the data has moved expectations to a 25 basis point cut, not a 50 cut. And what's led to that, just kind of big picture, is inflation's been a little higher than expected, and the jobs market has been a little stronger than expected. So they cut 50, they would cut more aggressively 50 if it's, oh no, recession's around the corner, unemployment is going up and inflation's no longer a concern. But that's not what the data has said. The data has said, no, inflation, it may not have gone away. You guys should still keep your eyes on it, and the labor market's fine. So that kind of memo that I just summarized from the data, I think that's how they're reading it, and their response to that should be a 25 basis point cut. So that's what we've seen kind of aggregate in the data. It has been mixed, but I think the by far consensus is a 25 basis point cut today.
Anything from there, Bob, in terms of what the next meeting would be pricing in the
It's
market?
all about the press conference and what Powell has to say, which I'll be tuning into, and I'm interested in hearing, but I haven't heard it yet. If I could ask one question, or the one question I'd want to hear is his comments on the 10-year Treasury. So the Fed controls the short end of the yield curve, T-bills, and they've been cutting that. So they're trying to bring rates down while they're in this cut pattern and cutting 50, now cutting another 25 today, probably. So cumulative 75 basis points in cuts. The 10-year has been going up. So they're trying to bring rates down, and long rates are going up, which is the opposite of what they're trying to do. And they don't have much control over the long end. So I'll be interested to hear what he thinks about that, and if they would try to do anything about it, or how they factor that in into their policy decisions. Because, for example, with mortgages, they're frequently tied to the 10-year Treasury. So if the Fed's trying to cut rates to help the economy out a little bit, well, the market's doing the opposite.
Yeah, I mean, just connecting that base maybe back to the what we were talking about with fixed income with bond yields. Is it a time then to shorten duration in bond portfolios?
Well, the yield curve's steepening, so short yields are going down, you're getting paid less, and long yields are going up, you're getting paid more. So if you're just purely looking at the yields, now,
I'm thinking, sorry, Bob, more the move in yields upwards, right?
right? So it depends on expectations for the future. Do you expect long yields to continue to climb? And that's a tricky one, because I don't think there's too much more room for long yields to go up at 4.4, 4.5%. With the amount of debt, I don't know that we need to get down into this path, but
Well, you've talked about that before, just the debt that we have as a country. If you have to pay interest on that, a 1 or 2 percentage points higher, it's crippling.
it's yeah. So and Powell has to think about that, even though that is not his job. It is part of the inflation math indirectly. So the U.S. has to service a lot of debt, and the higher the interest rate on that debt, the more difficult it's going to be. And there isn't too much more room for rates to go higher there without that being a problem.
Is that the I know the consensus is probably a kind of a tricky word, but is that the viewpoint of the bond managers that you're talking to, just in terms of the move of upwards or the potential move upwards?
It's frequently brought up, but we haven't experienced it too much as far as like real market implications. It's kind of in the back of everyone's mind as, well, someday this might be an issue, but not yet. But we did have a few instances where there were treasury auctions, I think in it was 2023, where there was more supply than demand. So it's come up a little bit as far as like real day-to-day market implications. But I think it's more in the back of everyone's mind as, that this isn't a good situation, but at the same time, we don't need to worry about it today.
That you're talking about on the debt and the deficit there. Yeah. Sorry, I was asking, have they shared any thoughts on the potential for rates to move higher, or is this kind of where they're capping out?
It's mixed. There's definitely room for them to go a little higher uh,
Okay.
with inflation and but predicting we've talked about this before.
Yeah, we've
Predicting the
talked about
direction
that.
of
Yeah.
interest rates is one of the hardest things to do in financial markets. So there's so much built into it, and it moves based on expectation. So as soon as a consensus is built, it's typically wrong.
So we've kicked around a lot. Obviously, it's been a busy week, and there are things that you've been watching, things that matter, things that don't matter, things we're just curious about, things that will never make their way into client portfolios. But coming out of Tuesday, heading into Thursday and the Fed meeting, what else are you going to be watching with your team over the next few weeks?
Yeah, it's tough to think beyond all the information we're digesting this week, really. It's inflation is probably the number one thing we're looking at, and different strategies around it. Like, for example, how we get exposure to real estate, to get a little granular there. We've seen REITs run up, so publicly traded real estate has done really well over the last year or two. Private real estate has lagged, so there might be an opportunity to move into private real estate because it typically does lag in returns. So that's one thing we're looking at. And then maybe not quite the next couple weeks, but more the next couple months, month or two. We do have an annual capital market assumption review process where we forecast returns for all asset classes and run our portfolios through an optimization process to revisit our overall asset allocation. So that's around the corner.
And that's an annual process that we do, but obviously the analysis is ongoing.
Yes,
Yeah.
always at least annually, and then if there's major market moves, we'll do interim reviews.
Speaking of capital market forecasts, before this week, something that I think had been getting a lot of attention was Goldman Sachs's call for very weak U.S. equity returns for the next decade. Did you see this? I mean, there was a lot of variability in their analysis, but the headline was 3% per year for the next 10 years. Did you see that? And do you have any thoughts when you see something like that, just in terms of how people should react to those?
I didn't see that specific one, but it's not far from many others that I have seen as far as capital market assumptions. And the typical process looks at valuations. What's the starting valuation now, like the earnings multiple? Where do we think the earnings multiple will be in, say, 10 years? And if we're above average levels today, frequently what some providers will do is assume reversion to the mean, assume you go back to average. And that framework leads to low returns in U.S. equities. So that gets back to what I said earlier on with well, Trump won. I'm not picking on him, saying he's dealt a bad hand. It's not, call it his fault, but it's going to be tough to get get the equity returns we've seen in the U.S. for the last 5 to 10 years over the next, if we're talking politics, over the next 4 years or the next 10 years, based on how Goldman looked at it. And just to break this down a little bit for our listeners, with stocks, there's really two main components of returns. There's multiple expansion or contraction. So if a stock is traded or the market's trading at 20 times earnings, if it balloons up to 30 times earnings, you make money. Or it can go from 20 times earnings down to 15 or 10. And that multiple expansion contraction is just what people pay. It can be, you could even look at it as a psychological element of return. And the other element that's more persistent, that you prefer to see is earnings growth. And as earnings grow, then prices should go up. And we've seen a decent amount of multiple expansion, which just is not sustainable. You just can't have multiples expand indefinitely. They typically expand, contract, etc. So that's kind of the headwind that the U.S. market will be facing is that multiples are on the richer side of history, and it's tough to see that continue from this level.
So, when I look at something like that, I tend to snicker sometimes just because of my experience in 2008, 2009. People were talking about, low equity returns coming out of that generational low, right? The new normal and all that. I always call it the new normal and all that other nonsense we got. But this time the setup is a little bit different. So you do have to pay attention to it because we're not coming off of stocks selling off 57% and a decade of weak returns, negative returns, really in aggregate. I think -9 for the S&P. So the setup's a little different, which you're referring to, and that valuations are higher. But valuations can stay higher for a while. And if the economy is strong and things are going well, you can make money in markets like this. I don't mean it for us to be coming across as pessimistic at all. I think I'm pretty excited about the setup for stocks, and I feel like what I touched on earlier does bear repeating. Late cycle doesn't mean the end of the cycle, and some of the best gains do come late in a market cycle. But what you're acknowledging is just the reality of the valuations and the starting point, and at some point, things do settle out. So, trying to get to that, I shared in something I wrote just to remind people, at least my viewpoint is, when you see we're going to have 3% returns for a decade, it's very hard to envision that it's just low single digits each and every year clocking in, right? Even the 2000 to 2010 S&P 500 being down 9%, the average year that was up during that decade was, I think, 13.5%. I'd have to double check that and clean it up if it's not right. Meaning it's going to be big down years, good years, and the average comes down to three. Not, stocks are going to be up 2 to 4% a year like a bond, and you're going to finish the decade wondering what happened.
Correct. Yeah, there's typically the late cycle, you typically have big returns up and then big declines. So volatility and um, markets do tend to run, and it's very hard to call the top of a market. We've looked at historical data, and if you're looking only at, let's say, 1 year out, valuations are basically useless because expensive markets actually tend to deliver pretty good returns on average. It's just
Hmm.
until they don't. And it's like you don't know if it's 1996, 97, 98, or 99 right now as an example. And I'm not drawing a perfect parallel to the 90s, but
That's a good parallel. Yeah. In
there
terms
were
of this point. Yeah.
there were people who looked like idiots for a while in the late 90s, hedge funds just going out of business and saying in 1996 saying it's all over. Look how crazy expensive this market is. And they went short and they were wrong for 4 years. So that there can be a lot of money to be made late cycle. But I'm trying to bring balance to the conversation. And you have a pretty decent economy right now that's about to get some stimulus. So that should be good. Good until it isn't. So I think that the bottom line with all this is diversify, take the right amount of risk, not too much, not too little, have a global allocation equities. Most people should have some fixed income, and don't make any big bets in any concentrated bets right now is how I'd look at it.
Yeah, you're right about the danger of being early. I mean, people, I don't know if they remember, but Greenspan's irrational exuberance line was in 1996. And I worked for a manager in the early 2000s who was very valuation conscious and started lightening up on areas of the market in 97, 98. And again, really early. Nobody cares when you're quote unquote eventually right if you're pretty early on a call. So definitely don't be a hero in terms of timing your portfolio and making dramatic changes. And if you see market sell-offs, you can't predict them. When you see them, you can react to them. You can rebalance. You can take advantage of opportunities, things that we do very proactively here. But, don't listen to something like this. Or I saw somebody else warn this week that basically this would be a terrible time to make major changes to your portfolio, right? Don't get sucked into the narratives, the warnings, the exuberant in any direction, whichever way you're leaning. Don't think that now all of a sudden you have new information to make major portfolio allocation adjustments. Just watch, just learn, process, see what's going on. You can make maybe moves at the margins. You can incorporate some of the stuff that we talked about, but this isn't a day to, completely change your investment strategy.
Well said,
I
Sammy.
know you'd agree with that one, Bob. That was a softball, I guess. What else is on your mind?
Maybe just one fun fact to possibly confuse our listeners and or reinforce that last message. If you look at Chinese stocks, they performed better under Trump when he was president than they did under Biden.
Hmm.
And if you think about that, Trump is kind of Mr. Anti-China, but Chinese stocks did better under him. And then if you look at energy stocks, like the Goldman Sachs Energy Index, that was down when Trump was president, and it did really well under President Biden. So some of these things that when I say that Chinese stocks did better under Trump and energy did better under Biden, that's not what you would expect if you just kind of followed the rhetoric and partisan politics and position your portfolio that way. So the takeaway, if you look at why that happened, the answer is there's a lot more to markets than the person who's occupying the White House. Be careful with politics, cast your ballot, which I hope our listeners did, and then you got to move on and don't center politics, which is, on the news 24/7 around your portfolio.
Yeah, no, well said. That's the main takeaway there is definitely the things you think are going to happen. There's so much more to it than that kind of simple reductive analysis. So it's good stuff. So you guys are going to be busy. Year end's always a sprint to the finish line. At Heritage, the teams are getting a lot of financial planning done for clients before year end, doing tax planning in the fourth quarter before we run out of the calendar year to make changes to impact your 2024 tax situation. People are making contributions before year end, getting their charitable contributions made. I think you guys are just looking at portfolio positions and are there any distributions coming from our funds or any tax moves, tax loss selling we need to do. So it's a really busy time at Heritage that was just made that much more interesting by the fact that we got an election this week. So I appreciate your time as always, Bob, jumping on, and I know our listeners enjoy the insight as well.
Great. Thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.